Hi, this is Aaron Eisenach, an expert in long-term care planning. Thank you for your interest in learning more about traditional long-term care insurance as a planning solution for funding the high cost of long-term care. If you know someone who owns long-term care insurance, it is most likely what I call traditional or stand-alone long-term care insurance. There are a number of companies that offer this form of coverage, and it is a great fit for the majority of clients. Let's go through the core decision one makes when designing such a policy. Think of traditional long-term care insurance as a pool of funds or benefit account, ready to help you pay for extended care services if the need arises. The benefit account is determined by making two choices. First, the daily or monthly benefit. The monthly benefit is the maximum amount the policy will pay for care in a number of settings. Most policies reimburse up to the full monthly benefit for care at home, in an assisted living facility, a skilled nursing facility, or even hospice care or adult daycare. The monthly benefit you choose is then multiplied by the second core decision you make, the benefit period. Now, you might think of the benefit period as how long your benefits might last if you need care, but that's only partially correct, as I will explain in a moment. The benefit period choices typically range from 1, 2, or 3 years, or even as long as 10 years. The benefit period is multiplied by the monthly benefit to create the benefit account. Let's do an example. If the monthly benefit chosen is $5,000 and the benefit period is 3 years or 36 months, the resulting benefit account is $180,000. If care is needed, the policy reimburses up to $5,000 per month. If the cost were, let's say, $7,000, the policy reimburses $5,000 per month, and the policy owner self-funds the remaining $2,000 in expenses out of pocket, which is much better than paying for all $7,000 out of pocket. In fact, when premiums in the past were lower than today's rates, it was common to design policies to cover nearly 100% of the projected cost of care. But today, the idea is to transfer some, but maybe not all, of the risk to the insurance company, and to remember that some coverage is always better than no coverage. Now let's assume that the cost of care in a given month is $4,200. In this case, the policy reimburses up to $4,200 per month, and the extra $800 stays in the policy for future use, and therefore the benefits would last longer than 36 months. The third core decision is which inflation option, if any, will be included in the coverage. All companies must offer 5% compound inflation protection, which increases the monthly benefit by 5% of the previous year's amount every year. As a result, the benefit account also increases by 5% each year. For example, a $5,000 monthly benefit will roughly double to $10,000 at the end of the 15th policy year, and the benefit account will have grown to around $360,000 in this example. Today, most find that a 3% compound inflation rider is more affordable than 5% compound. With 3% compound, after about 24 years, the monthly benefit and benefit account will have doubled in value. Other inflation riders are available, including options to accept offers over time to increase benefits. The fourth and final core decision is the elimination period, which you might think of as a deductible based in days, not dollars. Choices are commonly 0, 30, 60, or 90 days, or even up to 365 days. The elimination period is essentially how long one waits before benefits become payable. Of course, the longer the elimination period, the less expensive the policy. What's the most common elimination period chosen? It happens to be 90 days. Now, self-funding 90 days of care 5 years from now is one thing. Self-funding 90 days of care in 20 or 30 years before benefits begin might cost a substantial amount of money. Therefore, I recommend a rider that's called the waiver of elimination period for home care, which does just what it says. If home care is needed, the 90-day elimination period is waived, and all the days home care is received count towards the 90-day waiting period for care in a facility. Now that you better understand the basics of policy design, let me mention a very valuable optional benefit for married couples, common law couples, and oftentimes same-sex partners, known as shared care or shared benefits. When a couple includes this rider, one spouse or partner can use up all of his or her own benefit account and then have access to some or even all of the spouse or partner's benefit account. In other words, if each purchases a 3-year benefit account, one might be able to use all 6 years worth of benefits if necessary. And if one spouse or partner were to pass away without using any or all of his or her benefit account, the remaining benefit account transfers to the survivor for their future use for care. Note that not all companies offer shared benefits, and there are differences between companies' shared benefit riders. Finally, there are many other riders worth considering, such as a survivorship rider, which allows a surviving spouse or partner to have a paid-up policy if one spouse passes away after year 10. A limited pay rider, which allows the client to pay up the policy over 10 or 20 years. Or a non-forfeiture rider, which allows the policy owner to cancel coverage for any reason after the policy has been in force for 3 years or more, and still receive future long-term care benefits equal to the premiums that have been paid. Now for some of the highlights of traditional long-term care insurance. First, when compared to other planning solutions for long-term care, standalone or traditional long-term care insurance offers the highest degree of leverage, or, put another way, the biggest bang for the buck. Pay a few months or years of premiums, and if covered care is needed, a substantial pool of money is ready to help you pay for care. Next, traditional long-term care insurance offers a number of attractive inflation riders, and most companies offer shared benefits. Premiums are flexible, offering monthly, quarterly, semi-annual, and annual payment methods. Many people ask me if premiums are returned at death if long-term care was not needed. The answer is usually no, unless an optional return of premium at death rider is added. Do keep in mind that if the shared benefit rider has been included with the coverage, and one spouse or partner does not exhaust his or her benefit account, it remains with the survivor. Another advantage of traditional long-term care insurance over other types of coverage is the ability to shelter assets from Medicaid spend-down through the state partnership programs offered by most states. Generally speaking, when my client has a partnership-qualified long-term care insurance policy and needs care someday, for every dollar the policy pays for care, the policy owner can keep a dollar in assets and potentially still qualify for Medicaid. Now, there are some differences between states' partnership programs, and not every state participates in the program. Please see the blog and resources tab found on the homepage for more information. Next, we have the possibility of tax incentives for qualified long-term care insurance policies. Because I am not a tax advisor, I cannot give tax advice, but again, see the blog and resources tab for more information. Another advantage of traditional long-term care insurance is the ability to offer discounted policies to association members and to employer groups. When offered through an employer, we may also be able to take advantage of easier health underwriting, allowing more people to obtain coverage that otherwise might not qualify. Note that policies purchased at work are portable. You can take your policy with you and keep the discount when you leave your employer someday. Now let's talk about some other aspects of traditional long-term care insurance that you need to know. First, recognize that traditional long-term care insurance is a form of health insurance. But this form of health insurance is designed to pay for chronic, ongoing care that is not covered by your healthcare or Medicare. And as a form of health insurance, traditional long-term care insurance premiums are not guaranteed and may increase over time. Also, there is no death benefit provided by traditional long-term care insurance unless you add a return of premium at death rider. There is also no cash surrender or equity value to the coverage, and not all people are healthy enough to purchase it. Still, for the majority of Americans, traditional long-term care insurance can be an affordable and effective way to protect your family and lifetime savings from the devastating consequences of needing extended care someday. If you would like to learn more or receive a quote, please request a quote from the homepage, give me a call, or send me an email. If I'm not licensed in your state, I will find someone you can trust that is. Be sure to watch other videos at aaroneisenach.com to learn about other planning solutions. Thank you for listening and have a blessed day.